Okay, good morning everyone and welcome to the investment meeting for March 2015. Let's quickly go around the room, introduce ourselves for the record.
Good morning, everyone. Rosemary DeBellis, designee for Police Commissioner Bratton.
Margaret Jadala, SIS consultant to the board.
Joe Alejandro, designee for Patrick Lynch, Mubarak Abdul-Jabbar, John Puglisi, and Alice Yerno.
Chris McGrath, PBA by invitation.
Bob Ganley, SBA, designee for Ed Mullins, and proxy for the CEA, Roy Richter.
Lou Turco, LBA.
Michael Palladino, DEA.
John Dorsa, alternate designee for the Controller's Office.
John Mercerberg, Controller's Office by invitation.
Yvonne Nelson, Controller's Office by invitation.
Martin Gans, Controller's Office by invitation.
Susanna Vickers, designee for Controller Scott Stringer.
Scott Evans, Controller's Office by invitation.
John Adler, designee for Mayor Bill de Blasio.
Tony Rodriguez, designee for Finance Commissioner Jack Jihan.
Bob Senskestead, Pension Fund by invitation.
Kevin Holleran, Pension Fund by invitation.
Neil Messing, Office of the Comptroller by invitation.
Alex Tenier, Comptroller's Office by invitation.
Brian Cook, Comptroller's Office by invitation.
Chris Bach, Controller's Office by invitation.
Evan Nansen, Controller's Office by invitation.
Brittany Cole, Controller's Office by invitation.
Nicole Jambrisi, Police Pension Fund by invitation.
Okay, Scott?
Okay, thanks very much. We are going to start with the quarterly report. This is the second quarter of the fiscal year ending December 31st. We'll go to the quarterly booklet, spiral-bound notebook, page 11. And you can see that the return for the fund for the quarter was 2.17%, 17 basis points ahead of the policy index return. And we look at that excess return of 17 basis points, 11 of it was from the allocation effect, how much we had in various asset classes, and 6 basis points is the selection effect. If you flip to page 12, you can see the same thing on a 12-month basis. And then page 13 is on a 3-year basis. So you can see our returns relative to the benchmark are improving a little bit this quarter. If you look at a breakdown, you go to page 14. On the top, we break down the allocation effect. I'll just focus on the quarter. You can see that we had a positive effect from domestic equity of 8 basis points, and the biggest negative effect was 6 basis points on the downside with cash, or fixed income assets held for less than 4 years. Down at the bottom is the selection effect. This is how the managers are doing relative to passive investing. The biggest winner for the period was the developed equity group. This is the EFA managers, up 11 basis points. Private equity was up 12 basis points. And here you've got a fairly flat market with the lagged effect of private equity being measured in later periods. So this is a positive wind at the back for private equity after many quarters of wind in the face. We turn to page 15, you get a sense of how the police pension fund, Red Star, is doing versus the police benchmark, Blue Star. The lines are the quartiles. The top line is the top quartile. The larger thick line is the median performance. And we go to longer periods going from left to right. All the way on the right, 10-year performance. We're in the 38th percentile on the 10-year basis, which is good. The policy benchmark is a very tough standard, top 22% of all the funds. And as you look across, you can see that the policy benchmark is a very, very tough standard relative to the performance of most funds. That's all I have for the overall portfolio. We're now going to give you a breakdown asset class by asset class, and I'm going to turn to the managers to do that. The investment strategy managers, starting with our head of equities, John Mercerberg.
Hi, everybody. If you please turn to page 19. That's where we see the summary composite for total domestic equity. It shows that for the quarter and for most time frames, the overall composite is close to the benchmark, a little bit ahead for the quarter. Moving on to page 21, shows the small cap active composite. That composite underperformed for the quarter. 4 of the 6 managers trailed their benchmarks during this quarter. So if you see for some of the longer time frames, the active composite is ahead of the benchmark. Turning to page 22, we have the small cap passive composite, and as you see, that's close to the benchmark as we would expect. Next on page 23, we have the mid cap active composite, and for this quarter, both managers have underperformed the benchmark. Moving on to page 24, we have the mid-cap active composite. Of the 5 managers, 4 were under the benchmark for the quarter, and 1 beat the benchmark. You'll see, depending on the time frame, the active composite has been above or below. You'll see for the trailing 3 years, they're ahead, and that's, if you look at the managers that are in this composite currently, they have a 5-year track record or less. So overall, this group has been ahead of the benchmark. Moving on to page 25, mid-cap passive has been close to the benchmark, as we would expect. And then on page 26, we have the Russell 1000 active composite. Of the 5 managers in this composite, 3 beat the benchmark, and 2 were under the benchmark. And then next on page 27, the Russell 1000 passive composite, again close to the benchmark as we would expect. Page 28, the Russell 2000 passive account, also close to the benchmark. And then moving on to page 29, the emerging manager of managers composite. They trailed by over 300 basis points for the quarter, and all 4 of them, of the manager of managers, underperformed for the quarter. Any questions on U.S. equity?
One question, John. On going to page 20, is that 12-month trailing? The returns?
I believe these are quarterly returns on page 20.
On page 20, okay, thank you.
Moving on to international equity on page 31. The total developed market slide shows that both the active and the passive composites beat the MSCI EAFE benchmark for the quarter. Next on page 32, the developed market active growth managers were ahead of the benchmark for the quarter, even though it was a down quarter, and they're also ahead for most of the longer periods. On page 33, we see that the active developed value managers were ahead of the benchmark for the quarter, as well as most of the other trailing periods. On page 34, developed active small cap was behind for the quarter. You'll also see they have a shorter track record than most of the other composites. The same is true on slide 35, again a short track work record, though the small cap passive was a bit ahead for the quarter. Next on slide 36, we see that the developed large cap passive composite, again close to the benchmark as we'd expect. And then moving ahead to page 38, we see that the emerging markets composite was behind the benchmark. That was because the active managers underperformed for the quarter. They trailed by about 90 basis points for the quarter. But you can see the performance has been, in general, better than the benchmark for the other trailing periods. Are there any questions about the international equity accounts?
So on page 39, there's a snapshot of, for the REIT holdings. The REIT holdings are invested in a global REIT passive index. We've been doing that for a little over a year, so it's a short track record. However, for all time periods, if you can see from the dark bar, you'll see that police has outperformed its benchmark. Any questions? We'll move on to hedge funds.
40 is hedge funds. And just a couple of things to point out here. You've probably heard me say before that this shows you, in a way, the evolution of the hedge fund portfolio. The trailing 3 years, we're outperforming one benchmark and underperforming the other. That was when we were out of balance in terms of our strategy allocations. But, we've been in balance for almost a year now, and you can see that showing up in performance. So, last year we outperformed both benchmarks by around 100 basis points, one a little bit more than the other. And, fiscal year to date, as well as trailing 3 months, we're right in line with both benchmarks at this point in time. One of the other things that I wanted to mention about the hedge fund portfolio last year that I thought was pretty interesting, and it'll give you just a little bit of an idea of how tricky hedge funds can be. Last year, the best performing fund that we were invested in was actually the worst performing fund for us in 2013, and the best performing strategy for us last year was actually the worst performing strategy for us the year before. And not only were those the case, but the worst performing strategy in 2014 was actually the best performing strategy for us in 2013. So I just thought that was noteworthy. It doesn't happen all the time, but I thought it was noteworthy and wanted to point it out to you. So, any questions?
Okay, so on to fixed income. Turn to page 42. You'll see the snapshot of the pie chart of where the assets are invested. It's 34% of the fund, $11 billion, and by far the largest piece is core fixed income, which is the blue section. That's further broken down on the next page, on page 43, into its 3 subcomponents: governments, mortgages, and credit. You'll notice, and we've talked for a while, that we're underweight the Treasury sector and overweight the spread sectors, meaning mortgages and credit. As it turns out, in this particular quarter, because interest rates went down, Treasuries did best, so that didn't add value. And also in the difference column, you'll see negatives because each of the sectors underperformed. Of the 13 managers in the quarter, 6 outperformed, 7 underperformed. There's a theme here. The managers that underperformed were the government managers, and for the most part the mortgage managers, the managers that are most exposed to duration and changes in interest rates and expectations of rates. The credit managers, for the most part, which are, while they're exposed to duration, and that's why they underperform slightly, because there is duration in the portfolio, it's about credit and picking the right credits, and they did that well. For the longer-term record, for instance, the 1 year, 10 of 13 managers outperformed, and the only managers that didn't were the government sector managers because of the volatility in the interest rates. But even the underperformance is slight. It's several basis points. The program, as you'll see on the next page, for the underperformance that I'm mentioning, for the quarter on page 44, you'll see for the quarter the return was 191, and the underperformance taken together was 32 basis points, fiscal year 30 basis points. But the 1 year was just right on the benchmark, 3 basis points ahead, and long term ahead as we would expect it to be. The recent interest rate volatility has, managers have their expectations of what interest rates will be. Interest rates is one of the most difficult areas to predict, and not that the managers are trying to predict it, but if they're long something or short something and the portfolio ends up being long duration or short duration, in this case short duration, and interest rates go down, you will underperform as a result if you get the credit right. In the long run, it all evens out, but in the short run, you can have slight underperformance because of it. The good news is our guidelines limit what they can take as far as duration bets, and that's why you see the limited downside. For the next page, on page 45, next page 45 is Progress. Progress manages emerging manager funds for you. That kind of mimics 4+5 and has a similar result. Same reason for the quarter and for the year, slight underperformance because of duration, and for the 1 year period, slight outperformance. TIPS is on page 46. We're underweight TIPS at 2.9% total for the fund, just under $1 billion. Here it's actually a very similar story, but a little more exaggerated because there's more duration, there's more interest rate sensitivity in TIPS because it's a treasury portfolio, there's no spread. So it's really about inflation protection and duration. So when rates go up, prices go up, rates go down, prices go down, and tips don't necessarily move in lockstep with what so-called regular treasuries or nominal treasuries. These are referred to as real treasuries. And in this case, it was roughly flat, slightly behind the benchmark, the same 12 basis points, same for the year, and slightly ahead 5 years. As you know, we have a TIPS manager search that we brought to the board that we have a transition that we're progressing through, and we'll have a report for you on that in the coming months. High yield is on page 47. This is a different story. We have 7 managers here. For the quarter, the return was negative because high yield has a correlation to equity. Equity was up, so you would think it would be up. So why is high yield down when equity's up? And the answer in one word is energy. Energy went down by 50%. The price of crude oil went down by 50%. Other energy-related investments like natural gas and so on went down as well. Energy was one of the largest new issue sectors in the high yield market and has become a significant sector in the high yield market. And to the extent that managers own energy names, because these are energy names that are very reliant, if they're E&P exploration and production companies, they're very reliant on the production of energy. And if prices go down 50%, it's not economically viable. I'm thinking of fracking, let's say in North Dakota, something like that, that they issued something and our managers own it. It's an index. So we're behind by 17 basis points. But the reason the universe is down instead of being up is because of the overall preponderance of energy in the high yield market as a whole. Our managers, of the 7 managers, our 7 managers, 5 outperformed. So they navigated it well. Fiscal year to date, they're also behind, also a negative number, also because of energy. The 1-year number is roughly in line, and the long-term numbers are all good. But the recent phenomenon is actually not a duration issue, because that would be positive. It's because it's not correlation with equity, it's energy. Bank loans are on the next page, and bank loan managers are doing really well. The benchmark was down slightly, less than high yield, as you would expect. Down less, because it's less volatility, because it's higher in the capital structure. But our managers, and also down because of the same reason, because of energy. Also spreads widening a little bit. But our managers outperformed by 60 basis points, and for the year, nearly 100. Actually 70 for the fiscal year, nearly 100. Convertible bonds, 2 managers have done well. This is very exposed to to equity markets, and it's positive on both an absolute and relative basis for the year and for the 3-month period. The longer term period, it's ahead of the gray bar, which is the individual managers' benchmarks, behind the overall benchmark for convertible bonds. And as I mentioned, over a cycle, that will undo itself. Opportunistic fixed income is down similar. It's about energy. The good news here is what our opportunistic managers are doing. We talked about this in executive session. Is not short-term stuff, but longer-term stuff about either restructuring or opportunistically investing. But long-term, the results are very good. Unless you have any questions, I'll turn it over to Brian.
Martin actually did have a question. One, just kind of getting an update on the break-even rates that we'd asked at the break-even rates we'd asked for at the last police meeting. Just looking on page 14, looking at the allocation to less than 4-year treasuries acting as a significant drag. I was just wondering if we had any updates on that.
I'm going to give you the up-to-date numbers when I go over the things. I have them right here.
I have them in my head, but he has them. He
no
has them on the page.
So if you were going to go over later, then that's fine. We'll go.
I'm sorry, Mike.
Question. What do you anticipate the impact on bonds here? It seems to be, being that the dollar is stronger right now, there seems to be a flight lately from, I guess, overseas dollars into the U.S. markets, the equity markets, making them go up. You anticipate any impact on bonds?
There already has. You'll see when we go through this, and we've gone through this in several months prior. QE ended, and all the pundits a year ago were saying rates were 3%, started a year ago in 2014, 10-year rate was 3%. Well, how high was it going to go? Pick a number, 3.5, 4, 4.5, pick a number. And on the way up, it went down, below 2% recently. Now it's a little above 2%. How are rates going down, long rates going down, when the biggest purchaser of those, the Fed, isn't purchasing them anymore? They're reinvesting the interest, but they're not purchasing new bonds.
Right.
And the answer is because the U.S. is the strongest economy among the major developed market economies. If you look at Europe, if you look at Japan, those are economies that are either in recession or teetering on recession. And they are now, they're several years behind us, so they're doing QE programs that we've exited. In fact, in the U.S., the question is when will interest rates, short-term rates, go up? And what effect they'll have on long rates. So investors are not only buying equities, but they're buying fixed income. Because if you look at, let's say, in Europe, Spanish or Italian government bonds, 10-year bonds, the yields on those bonds are not much different from the U.S. yields, and in some cases lower on some days. That doesn't make sense because those credits are weaker. The reason for that is because of the QE going on in Europe. So investors see the higher rates here, the safer sovereign credit, the stronger economy, and despite the fact the Fed isn't buying, other investors have stepped in to buy. As the equity market in the last month, and we'll talk about this a little later, as the equity markets in February have really strengthened, some of the money has then rushed into equities and started bleeding out of bonds, so bond yields have started to creep up a little bit. So ultimately, in the long run, bond yields have to go up. But we've been saying that for a long time.
As we transition, Mike, our rebalancing program has us doing the opposite of the herd. So as everybody's putting money into U.S. equities, we're selling, and we're buying European equities and Asian equities. And as the market keeps changing its mind, as the central banks begin to try to resuscitate Europe, we're buying when everybody else is selling and selling when everybody else is buying. And so it's a good strategy long term, but short term it's a little discomforting because you're doing the opposite of what seems logical to everybody else.
All right, page 51, we have the economically targeted investments. I believe this is the last chart for the book. The ETI portfolio underperformed this last quarter by 17 basis points. We are, over the last trailing year, we are up 205 basis points. The primary driver of this underperformance actually came in our direct lending program, and as we switch to this book where we have the collateral reports, I'll discuss where, what the effect was. So if we go to page 7 of the quarterly book, we have the TPAR program on page 7 and 8, where we track both our investments and the number of units we have both historically and last quarter. The PPAR program underperformed its benchmark by 102 basis points this quarter, but it outperformed its benchmark by 359 basis points over the last fiscal year. The underperformance, the primary driver in this was that in December we had a loan that basically was a reasonably sized loan at a really high interest rate that chose to refinance with a different borrower for a lower interest rate. So our mark-to-market took a hit in this program. Because it's a direct lending program, they have the right to refinance, and because we don't sell it on the open market, we get the interest rate hit on that. I will say, in the fourth quarter, we purchased $11.3 million worth of loans, which will create or preserve 1,064 units of housing. And notably, I'd like to, because this doesn't happen that often, it includes 67 units on Staten Island of affordable housing in the Stapleton area. If we go to page 9, we have AFLO-CIO HIT, and that's also on page 10. We have their workforce housing initiative. The AFLO-CIO HIT outperformed its benchmark by 15 basis points in the fourth quarter, and is up 36 basis points over the last year. They measure themselves against the Barclays Ag, and I think I mentioned last quarter they underperformed. They are back above, so that is what we've come to expect from them. And yeah, we are passing out for Access Strategies a slightly updated handout. There is a $5 million investment that was made in HTC bonds that didn't get captured in our Excel spreadsheet. We caught it literally the day after the reports went out, but unfortunately with printing. Access Capital Strategies, this is the program that invests primarily in single-family homes, but also does do some multifamily investment. It outperformed its benchmark by 44 basis points in the fourth quarter, and by 187 basis points over the last year. As I mentioned, the big investment was the $5 million in HTC bonds, but in addition, the pension invested $1.7 million in 79 multifamily units in the Bronx.
Where is that $5 million reflected on the sheet?
Sure.
Yeah, so if you look at the top portion where it says multifamily investment details,
Yep.
The multifamily total all systems, it shows $8,474,605 invested.
Right.
Of that $8 million, $5 million is the HTC bond,
Okay.
and the balance is actually the other multifamily investments.
And if you look on page 11, just by comparison, that's at $3 million, so that covers the difference. I'm happy to answer any questions or turn it over to private equity.
Thanks, Ren. Alex Donier is up next with private equity.
So we will be working off of the large book for private equity, and I'll turn your attention to page 27. As a reminder, private equity reports on a lag, so we will be reviewing the September 30th, 14 quarter for the police portfolio. So on page 27, you have a snapshot of the active commitments and the overall portfolio performance. You will see as of the third quarter of last year, the PE portfolio had a market value of $2.2 billion, which represented 6.6% of total plan assets, relative to a 7% target for the asset class. If you refer to the bottom of the page, in the September column, second column from the left, police had $4.2 billion in active commitments across. I'm sorry, at the top of the page. I apologize. Police had $4.2 billion of active commitments across 100 managers and 161 funds. Once again, the market value of $2.2 billion, unfunded commitments of $1.3 billion, for a total exposure to the asset class in the quarter of $3.6 billion. Now, if you refer to the bottom of that same column, you will see the portfolio's performance since inception. Net IRR decreased slightly to 10.5% from 6.6% in the prior quarter ended June, and the net multiple remained steady at 1.37 times. Now let's turn actually back to page 11 for some of the quarterly highlights. So cash flow activity, you'll see that the portfolio was slightly cash flow negative for the quarter to the tune of $6.4 million. However, the portfolio...
I'm sorry, Alex, is it page 11 of
It's
the
about
book?
11 in the big book.
Sorry.
Right. So
Oh,
on
it's
the bottom of the page.
11 of the steps
it'll be
down there.
26.
Page 26.
Thank you.
So page 26, some of the quarterly activity.
Sorry, Alex.
Portfolio was slightly cash flow negative in the quarter to the tune of $6.4 million. However, you should note the portfolio has been cash flow positive 7 out of the last 9 quarters. If you look at the recent portfolio activity, you will notice that both for the quarter-over-quarter and year-over-year, we witnessed an increase in the value of the portfolio. The valuation increased $26.9 million, or 1.2% over the prior quarter, and $260 million, or 13.2% year-over-year. Stepping down the page, you'll see new investment commitments. Police closed on 1 commitment during the quarter, $85 million to Vista Fund 5, and subsequent to the quarter end through February 24th of 15, police has closed on an additional $78.4 million in commitments, and that's to 7 managers, 2 of which are core managers, 5 of which are emerging managers. Please turn to page 28. Just quickly on 28, you'll see performance by vintage years. As we said before, 01 to 03 were particularly strong performing years for the portfolio, and these were led by early commitment to some of your large buyouts and secondary fund managers, such as CVC, Apollo, Blackstone, Landmark. 04 to 08 were more difficult vintages as we underperformed the benchmark, and again, largely due to over-diversification of the portfolio to our non-core managers, as we categorize them, and also, of course, as a result of the difficult vintage years that preceded and leading up to the financial crisis. But lastly, if you look at the commitments that have been made since 2010, the vintages are posting very strong early results. Please turn to page 29. And you will see at the table at top, the portfolio returns presented over various time horizons. Since inception, once again, the portfolio has returned 10.5% net IRR. That lags the public market benchmark, which is a Russell 3000 plus 300 by 240 basis points. Looking at the one-year returns, the portfolio generated a 13.2% net IRR, which lags the benchmark by 770 basis points. So while strong on an absolute basis, it does trail the benchmark due to the strength in the underlying public markets. However, I would state that given the long-dated nature of the asset class, we believe the 10-year and the since inception stats are the most relevant to look at for this asset class. Lastly, just want to turn your attention to page 21. Sorry, page 36. And on page 36, we give you the geographic exposure of the portfolio by investment. And if you look at the very bottom, in terms of market value, 80% is exposed to North America. We have 15% to Europe, and the balance is rest of the world. I think what's interesting and also new that we're doing in this report and for subsequent reports is showing your exposure, the portfolio's exposure to New York State. So you will see this as a new entry in the bottom of page 36, where 7.1% of the portfolio is for New York State domiciled companies, and we're actually in the process of working on distilling that even further, breaking that even further to reflect exposure to New York City domiciled companies, which we expect to have hopefully in the next quarter. Yes, John?
Alex, when you say New York State or New York City domicile,
Their
that's by
headquarters.
portfolio company or by
This is
partnership?
portfolio company.
By portfolio company.
Yes.
Thank you.
We do have a page, John, if you like, and I can take you to that on funds.
No, I'm just
but this is
curious what you
at the
were measuring.
portfolio
Yeah.
level.
No, that's good. Thank you.
At the company level. Any questions?
Just more, I guess, for Scott. I just want to get an overview in the sense of how much capital do we have to work with for the rest of the year with regards to private equity?
We are slightly behind our pace that we have in the annual plan. Alex, where do we stand?
I don't have the exact numbers, Joe, but we are behind kind of the midpoint of the pacing plan for the year. I think you should anticipate in the next several quarters since the last fund that we brought in December, that we will be bringing investment opportunities before this board that will get us closer to the midpoint of our pacing before the year end of June 30th. So
Now,
we have many funds in active diligence today.
Okay, no, and how many people are actually working in the private equity area in the office?
So you have Alex Dunier, who's our head. You have James Del Guadio, who's a senior person. There's Luigi
Ferrara.
Luigi Ferrara is an investment analyst, and we have several others that are helping out. Have we announced the new hire? We have a new hire starting very shortly that will replace James's old job. We promoted James, and so we're back up to the strength that we were when I came. We were depleted when I came, and we will seek to get up to full strength. We did not have a full team when I came in, and do not have a full team now.
So what's the expectation that you will need? What would be a full?
So we have, in addition to the hire that we're making now, another senior investment officer, correctly?
Investment officer.
Another investment officer, and then
we're
that's
actively speaking to other candidates.
Yep.
Okay, so you're short by maybe what, 2, 3, 4?
Well, I think an optimally sized PE platform
That's what I'm trying to
for the size of New York City, the entire portfolio,
Right.
would be 8 to 10 people.
And
We've
what-
never, I shouldn't say that. I don't remember a time when we had 8 to 10 people in private equity for the city of New York.
And where are we now?
2, 3.
So, 3.
right. And you will, after you do the hires, be up to 5.
4, yeah.
No, because you've got two open.
Right.
Yep.
So my concern here is this, is at the end of the day, given the size of New York City, I think we're like the 5th or 6th largest pension plan in the United States, we're not getting the full service, not necessarily your fault or anyone's fault here at the table, we're just not getting the full service across all plans in New York City, given the size of the pension plan. And so my concern here is there a plan in effect to deal with that? I know we, along with several other plans, do corpus funding, and that should be dealt with regarding hiring. And I just want to get a sense as to where we are with that. Maybe not today, but in the next few days, if need be, and you have to consider it or whatever, just to let us know where we are with that.
So we, I know that not only this board, but all boards have been very willing to talk to us about if we don't have adequate corpus funding, to come to the boards to ask for more funding. We've been working, what I was working on first was to replace all the vacancies for people right under me. So we had no head of private equities.
But that would still leave you short.
No, I understand. And so we're building up all the vacancies that we had. We're trying to replace, and we're watching it as it goes to see how the staff is evolving and what we need. We finish these vacancies and finish the vacancies in the other areas, then we will assess whether we need to add more people. The other issue that we have, Joe, as you know, we're underpaying people tremendously relative to median pay levels for public pension plans, and so we
I find that's a problem endemic throughout city service.
Right. So but not compared to Wall Street, compared to other.
No, I know exactly what you mean.
So we're working to address that at the same time, because we have been we've lost a couple of people who are actually going to other public service jobs, and so we're wrestling both issues. But we appreciate the support. We'll be back to you.
Yeah, I just have a concern, again, given the size of this operation, and of course, our peers have other methodologies, of other budgets that they use. I just want to make sure that we're being treated as the size of fund that we are, that we're getting the right service. And I think, again, not your fault, but something that we can address, at least some of it.
Yeah. Thanks, we appreciate your support.
And Joe, we do have today vacancy postings since January for all levels within private equity. so-
Any space for a guy with 31 years in the police department?
Absolutely.
Very good experience with private equity. They need a cop on the beat.
Thank you.
All right, thank you.
So moving on to real estate, like private equity, I'll be reviewing the highlights of the third quarter 2014 results for the police portfolio. If
Have a
we
page
go
you
to
refer-
page 43 of the board book, I'll start, it's the real assets quarterly report. I will start with real estate, and my colleagues will advise you of the results of infrastructure. But as we heard earlier today, relative to macroeconomics environment, the real estate recovery is finally taken hold, with the U.S. leading the way, followed by Western Europe and Asia. This is a great investment environment for real estate today. The great surprise for 2014 is that interest rates remained low. Together with some healthy debt markets, it really drove up real estate values. Also, the level of investment activity globally certainly has seen an increase, with $850 billion of transactions changing hands in real estate. Just in terms of real estate itself, very strong fundamentals. We have occupancies going up, NOIs going up, and also rents going up. And so I'm going to review some highlights of the police portfolio so you can see how these trends translate into your portfolio. So there is a 6% allocation, as you know, to real assets, and that allocation would equate to about a $2 billion budget. The market value as of the third quarter is $1.2 billion. And as I kind of look back as to where we were just 12 months ago, we were at $1 billion. So that equates to a 20% year-over-year increase in value. We have about $550 million of commitments that we have yet to fund. So altogether, our exposure to real estate is $1.8 billion, and that's across 52 deals with 37 managers. And as it relates to our performance for the quarter, the performance for the quarter is 3.2%. I'll direct you to look down to the lower right so that we can kind of look at it graphically. You have the police portfolio in the blue or dark bar, followed by the light bar, which is our benchmark. The real estate benchmark is the NCREIF Odyssey Index. It's a core index, and we apply a 100 basis point premium in recognition of the fact that our program is comprised of both core and non-core strategies. So again, the results for the quarter was 3.2%, slightly under the benchmark at 3.3%. And as we move across the graph toward the right, the one-year result is 16.7%, which is 420 basis points ahead of the benchmark. 3-year also very strong at 260 basis points over the benchmark at 15%. Likewise, for the 5-year at 150 basis points over the benchmark. In the longer periods, the 10-year, and since inception, we're still looking to close the gap there under at 50 basis points for the 10-year and 150 points for since inception. As I kind of look to the activity, investment activity that we had for the quarter, was nothing happening in this particular quarter, 3Q. However, since the quarter, as you know, police has authorized the following commitments: $22.5 million in additional capital to Blackstone Europe 4, another $50 million to Almanac 7, and most recently, police committed $40 million to H2. So in terms of where we stand for our goals related to the annual plan, I think we established a target of about $400 million, and so this kind of gets us, a quarter of the way there at 112.5. We also have some proposals to discuss with you later on in the agenda that would represent new investment activity for the real estate program. So let's turn on to the following page. I'm going to go by the page numbers down at the bottom since the other pages seem to be blocked. So on page 2, we have, we drill down a little bit further into the portfolio in terms of the investment strategies that we pursue. So we talked about how we have core and non-core managers in terms of what optimally we'd like to see, no less than 40% in core plus strategies and no less than 40% in non-core strategies. At the moment, we are out of balance, where we are about 2/3 non-core and 1/3 core and core plus. Right after the crisis, maybe vintage 2010, 2011, we took a look together at what the landscape was and where the opportunities were, and there was a temporary overweight to non-core strategies to enable our managers to take advantage of the dislocations that they were seeing in the markets. These opportunistic funds, as you know, they have an investment period of about 1 to 3 years, and so it's natural to see this overweight. We no longer have such an overweight. We're just kind of waiting for it to work itself out. But meanwhile, those managers are doing exactly what we expected them to do in terms of finding those opportunities. And I guess the backdrop of a healthier market, we see that these managers are not only outperforming, which it harkened back to the first page with those large, outperformance for the 1 year and the 3 year. We have that overweight to non-core, so that's exactly what you want to see. They're supposed to be doing that, and that's what they're doing. But however, the market is also buttressing them because their business plans are being able to execute them sooner than they thought. The low interest rates allow them to refinance some of the investments, even making the total return even greater. And so, you will see that as we talk about on this page here, it talks about how we had contributions at $50 million, and that was offset by $81 million in distributions. These managers are working. They're working. They're executing their business plans. They're selling these assets into the ready hands of these core buyers, and they're sending it back to the systems. And so that's the kind of activity that we're seeing here. So, I know that we're out of balance, but just wanted to share with you some background information so that you understand that, perhaps maybe we were on the right track in doing what we did. So in terms of the portfolio, we're about 3.7% funded at this point, and 5.3% of the portfolio is committed. As we move on to the next page, page 3, what this page does is break down the performance for you according to what your core and core plus managers are doing, what the non-core managers are doing, and the emerging managers. So when you have the time, you can definitely go through it, but the highlights are, you have 14 core plus investments, and they produced a 2.7 net return for the quarter, and that was primarily driven by PRESA 2. The non-core funds, we have about 36 of them, and they delivered a return of 3.5% net, and the drivers there, DivCo West and the Blackstone funds 6 and 7. And down at the bottom, you see graphically the performance of the styles one against the other. The following page, page 4, is a drill down into the quarterly result. Nice picture, gives you a good sense of who's driving the returns. But then again, remember that this is a long-term asset class. So this is really kind of just an illustration to kind of show you which managers are particularly strong in producing outsized returns. And you'll see that there's some information given to you about DivCo West and Blackstone and Carlyle. For longer periods, you'll see this same diagram. Of course, the bars going out to the right show the outperformance. The guys in the middle, they just mean that they're just delivering what's expected, and the guys that are out to the left are delivering underperform returns. For longer periods, the 1 year and the 3 year, is on page 9 of this report if you want to take a look at that. But just moving ahead to page 5, we're looking at some charts on property type and geographic diversification to show you where the portfolio is. The police portfolio again being the dark line or the blue line, and the lighter bar being the core benchmark. So we don't try to manage the portfolio to the core benchmark because, as you know, we talked about how the portfolio is a blend of core and core plus, but we do want to share with you in terms of your core holdings what the rest of the industry is investing toward. Down at the bottom, geographic diversification. Similarly to what Alex told you about highlighting exposure to New York, we have in the first bar over to the left, northeast and E, we have a triangle there. The triangle represents 13.1% of the portfolio being in New York City MSA. And like private equity, we will continue to share that metric with you. Page 7, we're going to skip a page. So page 7 is really, I call it the report card. So essentially, if you take the primary risk metrics that are in the IPS and where we are today, this matches it up. And we talked about all these things already. We talked about the underperformance long term. We talked about the imbalance by strategy. In all other respects, the program is compliant, and you can always refer to this page for a quick look as to where we stand from a compliance basis. And that's what I have for you this morning. Any questions?
Thank you very much.
But actually, I had just like one or two, mostly clarifications. First, on page 2, in the table in the bottom, where it's uncommitted non-core portfolio, the negative 70, I guess that's going to be 77 million. Does that just say that we're essentially over committed to non-core? I want just clarification on that number.
No, right. It just means you have 77 million. You have that available.
Gotcha.
You know, you can shop with it. That's what you got in your wallet.
Gotcha. And then second question was on page 4, the fund contribution to quarter return. How long does it take for a fund to be kind of included in this? Is this only post-investment period, or is it kind of a lag 1 year, or are they included immediately? Because I can imagine, right, like in an early fund, you know, they, just by the nature of your investing, prior to any type of distributions or return, they would kind of be at the bottom. So I'm just wondering, like, is it inclusive of every manager immediately, or every fund immediately, or after a lag, after the
It's
investment
after the first capital call.
First capital call?
Yeah. And in fact, if you look at page 8, the second column, the first column after the fund name is the first drawdown.
Okay, so
Okay, that shows you when the clock started.
Okay, perfect. Thank you. That's it.
Anything else?
Thanks, Yvonne.
I'll leave it to Petra.
Petra?
Good morning. My notes will be very brief because infrastructure is the newest class in the portfolio, so there isn't much history and the funds are still in the very early stages of making investments in their portfolios. Police has invested in 3 infrastructure funds for 160 million. These investments are all in core infrastructure as defined by the IPS and meet the strategic and portfolio objectives that again are set in the IPS. At the end of the third quarter, the portfolio was funded at 20 million and 140 million are still outstanding. Again, it's very early in the portfolio construction, but we do see performance that is above the benchmark. The performance net of fees was at 8.9%, and this compares to a benchmark of 5.9 for that quarter. The benchmark as defined in the IPS is CPI plus 4, and again, this was 5.9% in third quarter last year. So this concludes my remarks. Happy to take any questions. Thank you.
Thank you.
Okay, so with that, we'll turn to the monthly numbers for January. And if you turn to this book, the January book, let's turn first to page 37. And it'll give you the total portfolio for the quarter. Now, this is true of every month, but particularly of this month, because the timing of the calendar and how quickly you guys meet at the beginning of the month. These are estimates. As Joe knows, we don't even get our final numbers until after this meeting has happened. So these monthly numbers are estimates, and you should view them as such. But if you go to the bottom here, we were down 32 basis points versus a policy benchmark that was flat. The equity market, as you can see, was down for the month of January. That's, of course, reversed in February, as we're now hitting record levels as February came to a close. I want to turn now to page 30 to look at the portfolio asset allocation on a adjusted basis, adjusted for the monies that we're holding to be called in the private asset classes. As you know, 0 means that we're exactly on our long-term policy weight. The various equity classes are on the left, the fixed income are on the right. You can see that this looks differently than it did at the end of the year. And the reason for this is January was the time that we moved the money to the VSF. And so that caused a big change, particularly in the equities, and it drew the equities down below target. Fixed income looks very much like it did before, but we're in the process of doing our normal rebalancing, and you'll see that more at the 0 target when you see this again. Turning to the fixed income side, remember that the Core Plus, our longer-term bonds, are underweight, and we're overweight the cash or holdings under 4 years. The mayor's office has asked us to, looking at both of those together, tell you guys where we are in terms of the overall duration of the fixed income, those two fixed income components, because we're holding the cash in order to bring the interest rate sensitivity or duration down a bit. So you have to look at the blue and the gray together. When you do that, you see that our duration is down from over 6 years to 5.88 years. And that's versus the Barclays aggregate of 5.55. So we're not quite down to neutral yet, Antonio, to answer your question, 0.33 years above. And, a duration of 1 would mean that when interest rates move 1%, you can expect the portfolio to move 1%. So we want to bring that down to benchmark levels as we're expecting over the next few years for interest rates to be on the rise. We're doing that without sacrificing yield relative to the Barclays Ag. Barclays Ag yields about 2.24%. This portfolio promising yield of 2.61% or 0.37% more. And that's because we're underweight governments and overweight structured and other spread product. So we're not yet to the sort of full cash level, even as we're flirting with the top end of the band. So we actually, given the band of 5%, may not be able to bring the interest rate sensitivity all the way down to the Barclays Ag levels. But this does show you that when you look at it closely, what we were talking about in general terms is in fact the case. Okay.
Just one follow-up on that one is I know we have a custom benchmark for kind of our 4+5, and the thought is essentially 0 to 4 is our kind of it all kind of gets defined at cash. I don't know, this is a much broader conversation just for today, but is there going to be thoughts that, maybe does our kind of core bond, kind of allocation start to look more like the ag, or do we think over time it's going to go that direction, or we still ultimately like the...
So I think we ought to revisit that when we talk about the overall asset allocation, and we're going to need to do that sooner rather than later, because the governor, as you know, vetoed the basket bill, which means that basket securities can only be 25% of the portfolio. So we're already talking with SIS and the other consultants about having a fresh look at the asset allocation. We'll take a look at this, Antonio. So what I can give you is just my personal thoughts about it, which is not necessarily where we'll come out after we talk to real experts on that. But I think what you have here is an exception to a structural position that we should have over a long period of time, which is to have a long duration, to have long-lived liabilities. And so it's probably the correct thing to have a longer duration benchmark during most time periods. We're in extraordinarily unusual circumstances right now with the bond market as a result of the tremendous easing that's happened from the Federal Reserve, and you've got interest rates on a real basis at or below zero. That's very strange and very unusual, and so I don't think we could we would want to set long-term asset allocation policy for those type of conditions. I think they're temporary. They may last for several more years. Certainly, if you look at the forecast of the market, people are still expecting them to last for a while. But we want to be positioned so that we don't have a structural bet of higher than average interest rate sensitivity in an environment where we think the odds are quite strong that interest rates will rise. So I think I view this as sort of a fairly long-term tilt that has a good reason, but is an exception to the policy.
One thing to add on, in addition to the ultimate discussion on asset allocation, which we'll have to have, as it turns out, once that happens, because of the core fixed income contracts, we'll have to have a conversation anyway in 2 years from now for the renewal for the RFP for that. So it's a natural discussion that we will have asset allocation and then core fixed income.
But we'll report this, the duration of the combined when we talk about this slide going forward, if that meets with what you guys are looking for. I mean, I can give you all kinds of details, which you probably don't need if we just stick to this basic duration exposure, which is something that we're watching.
Thank you.
Yeah. Okay, with that one, I turn over to Martin to give you the highlights of January, and then we'll move into the manager section in executive session. Martin?
Sure. So if you turn to page 27 of this book, where the market returns are shown, it's much like in December. Negative or lackluster equity market numbers. In fact, non-U.S. numbers in the second section were up slightly. Core plus 5, you'll see in the bottom, was up 2.45%. That's because interest rates really went down, and so core plus 5 benefited significantly. High yield was up slightly. Tips were up a lot. You'll see REITs in the very last column on page 28 was up. It's not a misprint. It was up 674. That's because of Yvonne's comments about the Goldilocks scenario right now going on in commercial real estate, as well as interest rates going down, and those are the two key factors for REITs. And so you'll see the fiscal year to date is 19%. That's not a misprint either. It's doing very, very well. We do not have February numbers for you, but I did in the book, because it wasn't ready obviously for the book, but I printed it up this morning for you. And the February numbers were extraordinarily good. And so, for instance, unlike negative numbers, you'll see next month the Russell 3000 up 5.5%, EFA up over 5.5%, emerging markets up nearly 3%. REITs are actually down about 3.5%. Convertibles were up 4%. High yield was up. Core plus 5 was down a little bit because interest rates started moving up a little bit. High yield was up. Ultimately, a good month, and I'll get to that in just a moment. So how did January look? On the very next page, on page 29, You see the bar charts on the left, bar charts, and take a look at the chart on the left. The return was negative 32 basis points, bringing the middle bar fiscal year-to-date return through 7 months at about 1%, 97 basis points. Given an estimate, and again, this is not an official number, but this is a reasonable estimate as to what those numbers were that I just read to you, what happened in February, it would be reasonable to expect that the number that you'll see in February will be closer to 4% for fiscal year-to-date. So it's a significant increase that you'll see for next month because of the good month in February. Again, that's not official, but we'll have the official numbers next month. As Scott mentioned on page 30, that's the asset allocation. You'll also see some numbers closer to zero on the equity side as well. One last comment. The market values that are shown on pages 35 and 36, because the market values have gone up, I'm estimating that we're back up to well over $33 billion for the total as of yesterday for the police pension fund. Starting on page 37 and 38 show details of individual manager returns. Unless you have any questions, it's the end of my comments.
Madam Chair, we conclude our comments in the public session and are happy to move to executive session if your wish.
So make a motion, we move to executive session.
Okay, take 5 minutes. Yeah. Unanimous.